This example, we're going to walk through how to truly calculate a labor burden. This is a labor burden just for a project manager or a non-union craft labor, non-prevailing wage. It does not include fringe benefits, and it's just a real good example of how to calculate it. Before we dive into the exact calculations, I want to say, this has to be probably one of the most incorrect terms that we hear thrown around in the industry. Seems like everybody has an opinion. Oh, we run at a 15% labor burden, a 13% labor burden. This is what I carried in my estimate. This is what it was at the last company, so on and so forth. We often get asked a question about, what's the average labor burden or something like that. There is no perfect answer to any of these things. The answer is sit back and do the math. Take a look at it individually for your company, the things that go into your labor burden, and the time. Quite honestly, these things change. I mean, your workers' comp rates change over time. State insurance rates change over time. Your unemployment factor changes over time. Variety of things change over time. So what's important is every year, every 6 months, you go through, you create some worksheets similar to the one shown for the different classifications within your organization, and make those available to estimators for estimating projects, make them available to project managers, so when they're calculating change order rates and things like that, they have all these tools available. Okay, this is all based on one worksheet like we saw on the front page. If you want a copy of this worksheet, it's really a work in progress. This isn't this perfect end-all be-all worksheet, so you're always going to have to add sections to it, adjust it to be specific to your company, change rates, things like that. If you want a copy of it, send a quick email over to info@dbrownmanagement.com, and we'll shoot it on over. Should be noted that this particular example, again, as I mentioned, it doesn't include union fringes. You could easily add in a section for that. Keep in mind that if you add in a section for union fringe benefits, not all of those fringes, some of them will and some will not be included in the tax rate calculations and such. Anyways, this worksheet, it's basically organized on the left-hand column. You've got numbers, 1 through 30. And then as we go through the worksheet, we're just going to kind of walk through each individual section. Very first section, this section number 1 starts with inputting the base pay rate, how many hours per year that they're working. Typically it's going to be 2,080, 52 weeks times 40 hours. Can't really take into consideration if somebody's working a lot more hours or something like that, unless it's a regular thing, and that's built into the labor rate. From there, it's going to back into their base hourly rate. This is how much it costs them essentially every hour that they're on the job. Next section, we're going to take a look at paid time off, assuming that this position, this classification of employee gets some type of paid time off, whether it's vacation, sick time, holiday time, or whatever you happen to call it, or total paid time off, PTO, however it is. We've got to take a look at that because we've got to factor that in. So in this case, this person's getting 23 days per year of vacation time, total of 184 hours. So they're only working 1,896 hours on the job. So what it is during, and why that's important, and we're going to see that later on in the calculation, is that later on we're going to have to basically account for in their total cost. This is actually part of the burden, because for every hour that they work, we've got to include a little bit in there for this 184 hours. You can see roughly this is 10%. So just right off the bat, you can look at that and you can see that approximately 10% of your labor burden is going to go to PTO for just somebody that has a couple weeks of vacation, some sick days, and your normal holiday schedule. Second thing, we've got the payroll taxes, death and taxes, all those nice little things that you can say. It's all true. These are all pretty straightforward calculations. You can look them up. Typically on the federal side, you've got your Medicare, you got FICA, federal unemployment, state unemployment. You may have some different ones depending on the state, or they may call it different things. Okay, these are going to have limits, meaning that they're either going to be paid on all hours and all dollars, or they're going to be paid up to a certain limit. Like for instance, as of the time of this recording, FICA cut off at $106,000 a year. Unemployment is for the first $7,000 of time that an employee spends within your company. So that's maybe why you notice something if you look at a job cost report, if your job cost system burdens the payroll. A brand new employee that just started on the job site might actually look like they cost more than the foreman, because it's actually a pretty substantial rate depending on what your unemployment rate is per state. And then those all come down to percentages. So fill in this information. Again, they get adjusted every year, but this one's pretty straightforward. This is probably going to be in your 8 to 7, 8, 10% range. Second thing we've got to take a look at is we take a look at all of our payroll-driven insurances. Now, workers' compensation is the first one that comes to mind. That's what you call it in a lot of states. L&I, they call it in other states. Whatever it is, it's basically the in case you get hurt insurance. And each labor classification is going to have a code and a rate that you're going to pay. That rate may vary, based on, some rates vary if it's over or under a certain dollar rate per hour, things like that. Got to look it up. It's all straightforward and available. You get the bill. It renews annually. It may or may not renew on the calendar year for your company. Some companies have their general liability insurance is tied to their labor hours. If so, that should be figured into the calculation. Okay, and then you can see that this rate comes up, for an office person, it's going to be relatively low. For maybe a higher risk craft employee, like a roofer, a roofing foreman, something like that, this rate could be pretty high. This rate could be in the 15, 18, 20% range. It all comes down to risk. So keep in mind that this changes on a regular basis, so any of these worksheets that you make have to be updated on a really regular basis. Employer paid benefits. So this is one. PTO is included in this. We're going to cover that last. But additional benefits. If there's any type of 401k match, you've got to include what that total burden could be or what an average is. You could take a look at what this specific employee is doing at this particular moment in time, but that's not really realistic. You can't completely count on that. So if you're calculating a burdened rate for T&M, cost reimbursable billing, you really have to calculate it for what your maximum exposure could be as a company. So just because today that employee may not be contributing that much to the 401k and you have a match, you maybe have to assume that employee could, something could change in their life and they could start contributing the maximum, in which case, if you have a 50% matching, you would be on the hook for the maximum. Same with healthcare benefits. Take a look at what the plans that are available, and you could take a look at it two ways. One, what plan does the particular employee have? Two, maybe what's the average plan cost for this group, this classification of employees? Or three, what's the maximum? There's not a right or a wrong, but you should just be really cognizant of what that range really looks like. So, maybe you take a look at one that is for a specific employee, a second one that's an average, and a third one, a third worksheet that is the maximum. And then you can kind of compare these at the end, and you can take a look at them. Obviously, if you're trying to go create backup for a time and material rate, for a claim, for what have you, you need to make some arguments that are going to, and again, those arguments are going to range somewhere between actual and what your maximum potential exposure is. But either way, so you get those things in, healthcare benefits, those are going up substantially every single year. And then third, we have to add back in our PTO benefit. That's the one that we calculated above. You can see that adds up to a decent amount. Remember, we talked about before, it's about 10%. So our total, and this is a big chunk of the burden, for employer paid benefits, depending on what they are, can range anywhere from, obviously from 0% if you had no vacation, no PTO, nothing. But they can easily range into the 35 to 40% range for employer paid benefits. Last section that you've got to take a look at is you've got to take a look at your indirect costs that go along with it. And the only ones that you have to include here, or I should say, if you don't include them here, if you don't include them in the labor rate, make sure that you bill for them separately, okay? This is really important to take a look at. A lot of times it's easier to go include these things in the labor rate and just start throwing this out there. But then as the labor rate grows, if you're working for a client that doesn't fully understand it, it's probably better to start stripping those out. So it's going to be more palatable to say, okay, our vehicle cost, maybe $1,250 a month, maybe, it's $800 a month for the vehicle payment and the lease payment, and then it's, $100 a month for licensing and registration, another $300 a month for fuel. Okay, so they don't drive very much. But anyways, whatever that calculation is, be very realistic about what your total vehicle cost is if the employee has a vehicle. Get your annual cost out there, and then that gets factored in to both an hourly rate and a percentage. And again, it may be more palatable to your customer to go bill for that separately, to say, okay, well, we're just going to bill, $3 an hour, $8 an hour, $100 a day, what have you, for the vehicle. Some other things we typically look at including in these indirect costs. Mobile communications, if it's a PM, a foreman or something like that, they've got a mobile phone. Possibly we've seen this happen before. If they've got mobile computers, project management software, licensing, things like that. If it's craft labor, consider things like small tools, prefab shop cost, training time, safety, your PPE, your personal protective equipment, things like that. Maybe it's an out-of-town job and you're building a labor rate for that. Consider your travel and per diem cost, your lodging. All those things should get factored in. Either that you need to make sure that they're billed for separately or that they get factored into the labor rate, one of the two. Summarizing this, bringing it all together, this gets us to our total burden per working hour. Okay, and that's really important. So remember, this isn't total burden for every hour, so that you could calculate, and one of the ways that a payroll administrator would calculate burden was that they're thinking primarily about payroll taxes and things like that. So they're calculating simply per hour. So that when somebody goes on vacation, they're calculating the payroll burden on that. When you're calculating labor burden as a project manager, as an estimator, and you're using this to go build a rate, it needs to be based on working hour, okay? Because our customers are they're not paying us for when the project manager's on vacation. They're paying us for when that project manager is actually working on their job. Minor nuance, but it adds a decent amount. Okay, so starting at the top, we've got our base rate. Come down, we've got our payroll taxes. That adds in another 8%. We've got our labor-driven insurances. Again, very low in this case because it's a project manager. It's an office personnel. It would be much, much higher if this were say a roofing framer. And then we've got our employer-paid benefits, and we've got our labor indirects. So we get to a total burden rate, or a total burden, of 65% in this example. It's pretty substantial. Even if we took this out, even if we took out the labor-driven indirects, we're still at a 45%, 44% burden. So that's pretty hefty, and that's a pretty far cry from what most people that we find in the industry, most estimators, most project managers have in their head for a total burden rate. And if you have a low number in your head, it can seem like it's just accounting. It can seem it makes it difficult to go sell the rate. Keep in mind some additional things. If you have regular annual bonuses or production bonuses that pretty much an employee gets constantly just based on the way that they work and how they work and they're out there every year, you've got to include those in some type of a rate calculation like this. So, and remember, our goal when we're doing this entire process is to get to a very accurate cost per working hour. We can worry about how we're going to get paid for this later on, but it is really, really important for when we look at a person, when we look, on the project team, that we understand exactly how much they cost per hour, okay? And that we're very comfortable with it. Okay, the last stage of this, we get in, we've got to figure out, we've got to mark this thing up, we've got to get to a billable rate, and we've got to figure out, is that gross margin? Is that something we can live with? Yes or no? Okay, so this is really straightforward at this point. We're going to assign the markup, okay, and that's just marking up the $67 an hour. So we mark it up $20 an hour, and we get to 87. So that could be considered our selling rate at this percentage of markup. This isn't this isn't meant to be an example of what you should mark it up or anything like that. This 30% was just a number that we pulled out for the example, and just because it was round. It's really, really straightforward. Should be noted, and if you're going to be using this in an estimate or something like that, or in a budget that you're going to be applying markup to the entire thing, then you're going to use this 67. Okay. If your second note is that notice the difference that your markup at 30% only yields a gross margin of 23%, and that's because your markup is based on your cost. Your gross margin is based on your revenue. And it's not accounting trickery or anything like that, but that's just the way it's calculated. So, and the reason that that's important is because when you're going out there and you're utilizing a resource, resources are precious. When you're utilizing a resource like a project manager, you should not be making less than what your average gross margin is on your lump sum projects. And so if you take a look back historically, and you've always brought in your projects at 20, around 20%, give or take. And again, gross margin is like burden. It fluctuates wildly between companies, and it's truly not that important. But whatever yours is, you should not be making less than that when you send out somebody for a T&M. Again, if you want this worksheet, you have any questions on this, I know this is a lot of math. It's probably completely boring, but it's extremely important. Shoot over an email, and we'd be happy to respond and get you this worksheet